Before we begin, a quick and important disclaimer. The following content is provided for educational and entertainment purposes only and does not constitute professional financial, legal, or insurance advice. Every individual's circumstances are unique, and the laws governing marriage and asset division vary significantly by state and jurisdiction. We strongly recommend that you consult with a qualified attorney, certified financial planner, or licensed insurance professional before making any decisions related to prenuptial agreements, insurance policies, or legal separations. The information presented here is based on historical trends and documented case studies and should be used as a starting point for your own due diligence. Every 13 seconds in the United States, a judge slams a gavel down, effectively dissolving a legal contract that, for most people, represents the single largest financial commitment of their lives. We are told from childhood that marriage is a bond of the heart, a spiritual union, and a romantic journey. But the cold, hard reality of the 21st century is that a marriage license is the most complex financial merger two people will ever sign. When that merger fails, the resulting economic fallout often looks less like a clean break and more like a scorched earth campaign. In the American legal system, the average contested divorce can cost anywhere from $15,000 to over $100,000 in legal fees alone, not including the actual division of assets. We are living in an era where a single failed relationship can erase 20 years of retirement savings, force the sale of a family home during a market downturn, and trap individuals in a cycle of debt that lasts for decades. This is the divorce industrial complex, a multi-billion-dollar machine that thrives on conflict and complexity. But what if you could hedge against that risk? What if you could treat the potential end of a marriage not as a personal failure, but as a manageable financial casualty? Today, we are performing a deep dive into the controversial, misunderstood, and increasingly relevant world of divorce insurance. For the modern American, the risk of divorce is statistically higher than the risk of a house fire, a car accident, or a critical illness. Yet, while we wouldn't dream of owning a home without a policy or driving a car without coverage, we approach the financial risks of marriage with a hope for the best strategy. This documentary explores why the insurance industry is finally stepping into the domestic arena to offer a product that many see as a safety net and others view as a bet against love. We will analyze the historical trends that led to this moment, the case studies of those who have navigated the financial wreckage of separation, and the specific mechanisms of how these specialized policies function in a high-stakes economy. By the end of this masterclass, you will understand the potential outcomes of viewing your marriage through the lens of risk management, and why this emerging sector of the insurance market is gaining traction among a new generation of Americans who are tired of being caught off guard by the gavel. To understand why divorce insurance is even a conversation in the 21st century, we have to look at the massive shift in the American economic landscape over the last 50 years. In the mid-20th century, the concept of fault dominated the legal landscape. You had to prove a transgression to earn the right to leave. But with the introduction of no-fault divorce laws, beginning in California in 1969, the floodgates opened. This change was a victory for individual liberty, but it created an unprecedented financial volatility for the American household. Suddenly, a spouse could be forced into a massive asset liquidation without any prior warning or legal cause. As we moved into the 1980s and 90s, the rise of the dual-income household increased the stakes even further. We were no longer talking about dividing one person's income. We were talking about untangling two careers, two 401ks, shared real estate investments, and complex tax liabilities. The problem today is that traditional tools like prenuptial agreements are often insufficient for the vast majority of the population. A prenup is frequently seen as a rich person's tool, something reserved for those with millions in premarital assets. For the middle-class couple whose primary wealth is built together after the wedding day, a prenup can feel both unromantic and legally redundant. Furthermore, prenups can be challenged in court, leading to the very litigation costs they were designed to avoid. This is where the concept of divorce insurance, or marriage transition insurance, enters the frame. It isn't designed to pay out if you get a boring divorce. It is designed to provide a lump sum of cash to cover the massive, unexpected costs of the transition. We are talking about the bridge money needed to retain a high-quality attorney, secure a new apartment, or maintain a standard of living while assets are frozen in probate or litigation. Consider the historical trends of the American middle class. For many, the house is the primary store of value. In a divorce, if neither party can afford to buy the other out, the house must be sold. If that happens during a high interest rate environment or a housing slump, the equity loss is catastrophic. Divorce insurance acts as a casualty policy against this specific type of wealth erosion. It is the realization that in the 21st century, the happily ever after narrative is competing with a 40% to 50% dissolution rate. In any other sector of life, a 50% risk of total financial loss would be met with immediate and robust insurance options. Why should marriage be any different? The development of these products has been slow because of a concept known in the insurance world as moral hazard. Traditional insurers were terrified that if people had a policy that paid out upon divorce, they might be incentivized to end their marriages for a payday. To counter this, the industry developed strict waiting periods. Most divorce insurance policies require a minimum of 48 months of premium payments before a claim can be filed. This ensures that the policyholder isn't buying the insurance on Monday, because they plan to file for divorce on Tuesday. This waiting period transforms the product from a bet into a long-term risk management strategy. It encourages couples to think about their long-term financial health during the honeymoon phase, rather than waiting until the relationship has already soured. We also have to look at the hidden costs that most people ignore until they are in the thick of a legal battle. There is the divorce penalty and taxes, the cost of COBRA health insurance if one spouse was covered by the other's employer, and the sheer loss of productivity at work due to the stress of the proceedings. Divorce insurance is aimed at mitigating these specific, documented economic pressures. It provides a liquid cushion in a situation where liquidity is usually the first thing to vanish. By studying case studies of high-conflict divorces, we see a recurring theme. The person with the most immediate access to cash usually fares better in the final settlement because they aren't forced into a desperation deal just to pay their bills. This documentary is not just about a financial product, it's about a cultural shift. We are witnessing the unbundling of marriage from the romantic ideal and its recategorization as a significant life event with measurable risks. In the following sections, we will break down exactly how these premiums are calculated, the specific data points that insurers use to determine your risk profile, and the step-by-step process of how a claim is actually processed in the American court system. We are going to look at the hard data, the legal precedents, and the real-world implications of what it means to insure your heart by protecting your wallet. This is the reality of love and money in 21st century America, and it starts with admitting that while the vows say "until death do us part," the statistics often have a different ending in mind. Over the next 9 parts of this deep dive, we will dismantle the taboos surrounding this topic and provide a comprehensive look at the potential outcomes of the most modern form of protection available today. To understand the mechanics of how divorce insurance operates in the year 2026, we have to look past the emotional veneer of marriage and examine the cold mathematical architecture of risk pooling. In the insurance industry, this is often referred to as a casualty policy for a domestic contract. Imagine a couple living in a suburb of Charlotte, North Carolina. Let us call them Michael and Jessica. In 2026, Michael is a mid-level project manager in the green energy sector, and Jessica is a specialized nurse practitioner. They have 2 children, a mortgage on a home that has doubled in value since 2021, and 2 separate 401k accounts that are heavily influenced by the volatile markets of the mid-2020s. On paper, they are the American success story, but statistically, they are also in a high-risk demographic for what sociologists now call the mid-career fracture. If Michael and Jessica were to separate tomorrow, the immediate financial shock would not be the division of their house, but the sudden requirement for liquid capital. In 2026, the average retainer for a family law attorney in a metropolitan area has climbed to $12,000 per person. That is $24,000 exiting the family unit before a single document is even filed with the court. This is where the concept of the divorce insurance unit comes into play. Most modern policies are structured around these units of protection. For a monthly premium, a policyholder purchases a specific amount of coverage. Historical trends from early pioneers in this space, such as the wedlock firm of the 2010s, showed a model where every $15 or $20 in monthly premiums might correlate to $1,250 of coverage. By 2026, these models have become significantly more sophisticated, utilizing AI-driven actuarial tables that look at a couple's specific risk factors. When Michael signs up for a policy, the insurance company isn't just asking for his age and income. They are looking at the stability of his industry, the geographical divorce rates in North Carolina, and even the length of time he and Jessica were together before marriage. This data determines his premium. But here is the crucial step-by-step detail that many overlook. The waiting period. Divorce insurance is almost never an immediate benefit product. To prevent people from buying a policy specifically because they are planning to leave their spouse the next month, insurers implement a 48-month or even a 60-month lockout period. During this time, Michael pays his premiums, but he cannot file a claim. If the marriage dissolves in month 36, he receives nothing. This waiting period is the industry's primary defense against moral hazard. It ensures that the policy functions as a long-term safety net, rather than a tactical weapon in a pre-planned separation. Now let us look at the potential outcomes for Michael and Jessica if they reach the 5-year mark of their policy and then decide to part ways. In this scenario, Michael has been paying for 50 units of coverage, totaling a monthly premium that fits within their household budget, much like a premium for high-end disability insurance. Upon the legal triggering event, usually the formal filing of a summons and complaint for the dissolution of marriage, the policy enters the claim phase. Unlike health insurance, which might pay a provider directly, divorce insurance typically provides a lump sum cash payout to the policyholder. This liquidity is the bridge that prevents the catastrophic wealth erosion we see in so many case studies. Consider the case of David, a fictional but representative character in the 2026 economy. David is 55 and facing a silver divorce after 28 years of marriage. His assets are tied up in real estate and a pension plan that cannot be liquidated without massive tax penalties. When his marriage ends, he doesn't have the $60,000 in cash needed to fight a prolonged legal battle over the valuation of his business. Without insurance, David might be forced to settle for a lopsided agreement just to end the bleeding. However, because David maintained a divorce insurance policy as part of his broader wealth management strategy, he receives a lump sum of $80,000 within weeks of the filing. This cash allows him to hire a forensic accountant to properly value his assets and a high-tier legal team to ensure the division is equitable. The insurance didn't make him rich. It simply leveled the playing field and protected his long-term retirement stability. In the 21st century American economy, the cost of living has outpaced wage growth for many, meaning that most couples do not have $100,000 sitting in a liquid savings account. They are asset-rich but cash-poor. A divorce in this environment is a liquidity crisis. We have seen historical trends where one spouse uses their superior access to cash as a leverage tool, essentially starving the other spouse into submission by dragging out the legal process until the other party can no longer afford their attorney. Divorce insurance is being positioned by some financial educators as the ultimate equalizer in these wars of attrition. By providing the lower-earning spouse or the spouse with less access to liquid funds with a dedicated legal war chest, the policy ensures that the legal system operates as intended, rather than as a tool for financial bullying. But the complexity goes deeper. In 2026, we are also seeing the rise of mutual policies, where both spouses agree to the coverage as a form of pre-funded alimony. Imagine Sarah and Robert, a younger couple starting out in 2026. They recognize that their marriage is a high-stakes partnership. They decide to build the cost of divorce insurance into their monthly lifestyle tax, right alongside their car insurance and their Netflix subscription. They view it as a way to ensure that if the relationship ever ends, neither of them will end up in a state of financial ruin or moving back into their parents' basement. It is a pragmatic, almost clinical approach to a highly emotional event. The actuarial science behind this is fascinating. Insurers in 2026 have identified that the most dangerous years for a marriage are years 3 through 7. If a couple survives this window, their risk profile drops significantly, and some policies in this era even offer no-claim bonuses or reduced premiums for long-term stability, similar to how a safe driver is rewarded. This creates a strange paradox. The insurance policy, designed for the end of a marriage, actually encourages the couple to check in on their financial health and relationship status regularly. However, we must also address the reimbursement versus lump sum debate. Some newer 2026 policies have moved away from the lump sum model to a reimbursement model. In this setup, the insurance company acts more like a specialized auditor. They will pay the law firm directly, but only if the law firm's fees are within reasonable and customary limits for that zip code. This prevents attorneys from artificially inflating their bills just because they know an insurance policy is in place. It adds a layer of oversight to the divorce industrial complex that has never existed before. As we move forward, we have to ask, is this product actually protecting the family, or is it commodifying the end of the American dream? The data suggests that for those who have used these policies, The primary benefit is the reduction in post-traumatic financial stress. When you aren't worried about how you will pay for your next meal or where you will sleep next month, you are less likely to engage in high-conflict, retaliatory legal maneuvers. The insurance, in a roundabout way, might actually lead to more civil divorces. But there is a dark side to this industry that is just beginning to surface in 2026. While proponents point to the stability it provides, critics and state regulators are raising alarms about the incentive structures these policies create. If the payout is large enough, does it change the way a spouse views a rough patch in their relationship? And more importantly, who is actually allowed to sell these products? The legal battle over whether divorce insurance is a standard casualty product or a bet on human behavior is reaching a breaking point in the American court system. In the next part of this deep dive, we are going to look at the massive legal pushback from state insurance commissioners and why some states have effectively banned these policies, calling them a violation of public policy. We will explore the secret risk scores that insurers are using to track your marriage without you even knowing it. And we will reveal the specific clause in most 2026 policies that could leave you completely uncovered even after paying premiums for a decade. The transition from I do to I'm covered is far more dangerous than it looks on the surface. The regulatory wall that divorce insurance has hit in the mid-2020s is perhaps the greatest hurdle to its mainstream adoption. To understand why your policy might be worthless despite years of payments, we have to look at the historical trends of state-level insurance regulation in the United States. Unlike federal banking laws, insurance is governed by 50 different sets of rules, and in 2026, a massive legal schism has formed between states that view divorce insurance as a pragmatic financial tool and states that view it as a violation of public policy. Consider the case of Marcus, a 38-year-old software architect living in Brooklyn, New York. For 6 years, Marcus diligently paid premiums on a high-value divorce insurance policy, accumulating what the industry calls vested units. He viewed this as a critical component of his diversified portfolio, right next to his index funds and his term life insurance. However, in early 2026, the New York State Department of Financial Services issued a landmark ruling. They argued that because the policyholder has direct control over the triggering event, the decision to file for divorce, the product is not a true insurance contract, but rather an aleatory wager on the duration of a marriage. Under New York law, this was reclassified as a form of unlicensed gambling. For Marcus, the potential outcomes were devastating. His policy was effectively voided overnight. While the insurer was forced to return his premiums, the 6 years of protection he thought he had purchased vanished exactly when his marriage began to falter. This regulatory volatility means that in 2026, your coverage is only as strong as the political climate of the state in which you reside. If you move from a pro-insurance state like Texas to a restrictive state like New York, your entire safety net could dissolve the moment you cross the state line. This brings us to the most controversial aspect of the 21st century divorce insurance industry: the secret risk score. In 2026, insurers are no longer relying on simple questionnaires. They have moved into the era of predictive behavioral analytics. Imagine if every digital breadcrumb you leave behind was being used to calculate the likelihood of your marriage ending. This is the reality for Elena, a fictional but representative consumer in San Francisco. When Elena applied for an increase in her coverage limits, she was shocked to receive a denial letter citing a high volatility score. The insurance company didn't explain how they arrived at this number, but historical trends in data scraping suggest a terrifyingly deep reach. Actuarial models in 2026 are now integrated with third-party data brokers who track consumer behavior. For Elena, the red flags were subtle. Her credit card data showed a sudden increase in spending at boutique hotels within her own city, often a sign of a trial separation. Her social media sentiment analysis, processed by an AI, detected a shift in her language from we and us to I and me over a 6-month period. Even her GPS data from her ride-sharing app showed she was spending less time at her primary residence and more time at a zip code associated with high-density rental units. To the insurance company, Elena was no longer a safe bet. She was a looming claim. In the world of divorce insurance, the moment you actually need the protection is often the moment the algorithms decide you are too risky to cover. Furthermore, we must examine the step-by-step reality of the exclusion clause. In most 2026 policies, there is a tiny section titled Material Misrepresentation of Marital Health. This is the trapdoor that catches thousands of policyholders. To illustrate, imagine a scenario where a couple, let us call them John and Sarah, purchase a policy in 2023. They have been having some minor arguments and attended 3 sessions of marriage counseling to smooth things over before signing the paperwork. They didn't mention the counseling on the application because they viewed it as proactive maintenance, not a sign of a failing marriage. Fast forward to 2026 and the marriage ends. John files a claim for a $50,000 payout to cover his legal fees and the cost of moving. During the claims adjustment process, the insurance company exercises its right to audit John and Sarah's medical and financial records. They discover the 2023 counseling sessions. Under the misrepresentation clause, the insurer argues that the marriage was already in a state of pre-existing instability at the time the policy was issued. The claim is denied, the policy is rescinded, and John is left to face a high-conflict legal battle with zero liquid support. This is not a rare occurrence. Case studies from 2025 show that nearly 15% of all divorce insurance claims are contested by the insurers based on these types of look-back investigations. The insurance companies are also dealing with the challenge of collusion. In a standard car insurance claim, it is relatively easy to prove if an accident was staged. In a divorce, how does an insurer prove that a couple didn't just decide to get a paper divorce to trigger a 6-figure payout? To mitigate this, policies in 2026 have introduced the cohabitation surveillance period. If you receive a payout, you may be required to sign an affidavit stating that you will not reside with your former spouse for a period of 24 to 36 months. Some high-end policies even reserve the right to monitor your digital footprint or hire private investigators to ensure you aren't gaming the system. This turns the insurance company into a literal shadow over your post-divorce life. We also have to consider the data regarding the divorce penalty in the 2026 tax code. Many people assume their insurance payout will be a tax-free windfall, similar to a life insurance death benefit. However, the IRS has yet to issue a definitive ruling on the taxability of divorce insurance proceeds. In many case studies, we see the government attempting to classify these payouts as ordinary income or short-term capital gains. This means that if you were counting on a $40,000 payout to cover your legal fees, you might find yourself losing $12,000 of that to federal and state taxes, leaving you significantly short of the funds needed to maintain your legal defense. The step-by-step calculation of your net recovery must account for these potential tax liabilities, which are often buried in the fine print of the policy's disclosure statement. As the industry matures, we are seeing a shift toward what is known as parametric divorce coverage. Instead of paying out based on the actual cost of your divorce, these policies pay out automatically based on a specific trigger, such as the final decree of dissolution. While this sounds simpler, it often leads to even lower payouts than expected, because the fixed sum does not account for the inflation of legal fees in high cost of living areas like Seattle or Miami. A policy purchased in 2021 for a $20,000 benefit is worth significantly less in the 2026 legal market, where attorney rates have climbed by 30%. The complexity of these products is creating a new class of financial victims. People who are overinsured for a divorce that never happens, but underprotected for the one that does. We are seeing a historical trend where the most vulnerable individuals are sold these policies as a form of empowerment, only to find that the legal loopholes are specifically designed to protect the insurer's bottom line. The transition from being a protected spouse to a denied claimant is a bureaucratic nightmare that involves thousands of pages of discovery and months of waiting. But what if the danger isn't just coming from the insurance company or the regulators? What if the very existence of the policy becomes the catalyst for the divorce itself? In the next part of this deep dive, we are going to explore the psychological phenomenon of the insurance trigger. We will look at how the knowledge of a hidden escape fund changes the power dynamics within a marriage, and we will reveal the high-tech ways that spouses are now using AI-powered discovery tools to find their partner's secret insurance policies during a trial. The most dangerous secret in your marriage might be the one you bought to save yourself. The moment a spouse secretly signs a contract for divorce insurance, the fundamental chemistry of the marriage undergoes a subtle, often irreversible shift. This is what sociologists in 2026 are calling the insurance trigger. It is the psychological safety net that, while designed to protect, can unintentionally lower the threshold for conflict resolution. Imagine a character named Tyler, a high-performing sales director in Austin, Texas. In 2021, Tyler watched his brother lose 60% of his net worth in a grueling 3-year legal battle. Determined to avoid a similar outcome, Tyler quietly took out a high-limit divorce insurance policy in early 2022, paying $300 a month into a plan that would provide a $200,000 lump sum after the mandatory 5-year vesting period. By 2026, Tyler's marriage to Amanda is under the normal pressures of middle age, career pivots, the cost of childcare, and the gradual drift that happens in long-term partnerships. In a standard scenario, Tyler might be incentivized to invest heavily in marriage counseling or intensive communication workshops to save the union, knowing that the alternative is financial ruin. However, with the 5-year vesting period nearing its end, Tyler's subconscious calculation has shifted. He isn't looking for a divorce, but the fear of it has been neutralized. Historical trends in behavioral economics suggest that when the cost of an exit is lowered, the frequency of the exit increases. This is not to say that Tyler is being malicious. Rather, the existence of the policy acts as a silent partner in every argument, whispering that he will be okay no matter what. But here is where the 2026 technological landscape complicates the secret. In previous decades, a secret insurance policy could remain hidden in a desk drawer or a private digital file. In the current era of legal tech, secrecy is becoming an expensive illusion. During a standard discovery phase in a 2026 divorce filing, attorneys are now employing AI-powered financial forensic tools, often referred to as asset spiders. These programs do not just look at bank statements. They scan years of digital footprints, recurring microtransactions, and even metadata from email headers. If Amanda's legal team suspects Tyler is withholding information, they deploy these tools to look for anomalies. A recurring monthly payment of $300 to an entity that sounds like a generic holding company is a red flag. In many 2026 case studies, we see that these secret policies are discovered within the first 30 days of legal proceedings. This discovery often transforms a standard no-fault divorce into a high-conflict battleground involving allegations of marital waste. Marital waste, or the dissipation of marital assets, is a legal concept where one spouse uses joint funds for a purpose that does not benefit the marriage. If Tyler used his salary, which is considered community property or a marital asset in many states, to pay for a policy that only benefits him, a judge in 2026 may rule that he must reimburse the marital estate for every dollar spent on those premiums. Furthermore, the potential outcome of the insurance payout itself becomes a point of intense litigation. Amanda's lawyers will argue that since the policy was purchased with marital funds, the $200,000 payout should be split 50-50. Tyler's argument is that the policy is a personal casualty product, much like a disability payout. The legal system is currently struggling to categorize these funds, leading to a new type of courtroom drama: the trial within a trial. Imagine the scenario in a courtroom in 2026 where the judge must decide if a divorce insurance payout is an asset to be divided or a tool for transition. If the court decides it is a divisible asset, the very purpose of the insurance, to provide liquidity for the individual to move on, is defeated. This creates a paradox. The policyholder buys the insurance to ensure they have the funds to fight for their fair share, but the existence of the policy gives the other spouse a larger target to aim for. Beyond the legalities, we must analyze the step-by-step reality of what happens when the insurance company itself becomes a litigant. In 2026, insurers are not passive payers. They have a vested interest in ensuring the divorce is not a result of collusion. This leads to the deployment of what the industry calls domestic integrity audits. If Tyler files a claim, the insurer may use AI to analyze his and Amanda's public and private digital interactions over the preceding 24 months. They are looking for evidence of what they call premeditated dissolution. If the AI finds that Tyler was researching divorce attorneys or looking for new apartments 18 months before he filed his claim, the insurer may deny the payout based on a bad faith application. They will argue that Tyler knew the marriage was over before the vesting period ended and intentionally delayed the filing to trigger the payout. This leaves Tyler in a catastrophic position. He has triggered the end of his marriage, he is being sued by his spouse for marital waste, and he is now in a secondary legal battle with a billion-dollar insurance corporation over a denied claim. Historical trends show that whenever a new financial product enters the domestic sphere, the first decade is defined by these types of high-stakes failures. We saw it with the rise of complicated prenuptial clauses in the early 2000s and with the division of cryptocurrency assets in the 2010s. Divorce insurance in 2026 is currently in its Wild West phase. The data suggests that while the product is marketed as a way to provide peace of mind, the actual execution of a claim involves navigating a minefield of digital forensics, tax ambiguity, and evolving case law. Furthermore, we are seeing the emergence of the insurance-fueled litigator. This is a new breed of attorney who specifically targets clients with high-value divorce insurance policies. These lawyers know that if their client has a guaranteed payout coming from an insurer, they can be more aggressive, file more motions, and extend the discovery process because the legal war chest is already funded. This inadvertently drives up the total cost of divorce for everyone involved. Instead of the insurance making the process smoother, it can act as high-octane fuel for an already burning fire. The economic impact on the insurance companies themselves is also worth noting. In 2026, several smaller firms that pioneered divorce insurance have already declared bankruptcy or been absorbed by larger conglomerates. The reason is simple. They underestimated the accuracy of human intuition. People are incredibly good at sensing when a relationship is nearing its end, and they are even better at securing insurance just before the point of no return. This has forced the remaining insurers to raise premiums to levels that only the upper middle class can afford, further widening the divorce gap between those who can afford a protected exit and those who are left to drown in the financial fallout. As we look at the potential outcomes for someone like Tyler, it becomes clear that the secret policy is rarely a clean escape. It is a complex financial instrument that requires more maintenance and carries more risk than most people realize when they sign up for that first premium. The transition from I do to I'm out is being mediated by algorithms and adjusters, and the human cost of this commodification is only just being tallied. But what if the danger isn't just about the money being discovered? What if the very act of insuring against divorce changes how the IRS looks at your entire marriage? In the next part of this deep dive, we are going to expose the tax trap that is waiting for policyholders in 2027. We will look at how the federal government is reclassifying these payouts as unearned windfalls, and why your $80,000 safety net might actually trigger an IRS audit that goes back 10 years. The government wants its cut of your heartbreak, and they have found a way to get it through the fine print of your policy. To understand the tax trap of 2026, we have to look at how the Internal Revenue Service has historically viewed insurance proceeds. In the United States, the general rule under Section 61 of the Internal Revenue Code is that all income is taxable unless specifically excluded. While life insurance proceeds are generally excluded under Section 101, and personal physical injury settlements are excluded under Section 104, divorce insurance falls into a gray area that the IRS began aggressively targeting in late 2025. This is not a theoretical concern. It is a mathematical reality that is currently dismantling the financial recovery of thousands of Americans. Imagine a case study involving Chloe, a 34-year-old creative director in Chicago. In 2021, Chloe began paying premiums on a mid-tier divorce insurance policy. By early 2026, her marriage dissolved, and she successfully navigated the 48-month waiting period. She received a check for $85,000. To Chloe, this was her life raft. She used $60,000 of it immediately to secure a high-end legal team, and the remaining $25,000 to sign a lease on a new apartment and furnish it. However, because this payout did not stem from a physical injury or a death benefit, the insurance company was required to issue a Form 1099 MISC to both Chloe and the IRS. When Chloe filed her 2026 tax return, she discovered that the federal government classified that $85,000 as ordinary income. Because Chloe was already in a higher tax bracket due to her professional success, this windfall pushed her into a 35% federal tax bracket. Suddenly, she owed nearly $30,000 in federal taxes on money she had already spent. Furthermore, because Illinois has a flat income tax, she owed an additional $4,000 to the state. Chloe's $85,000 safety net was effectively reduced to $51,000 after the tax bill arrived. This is the potential outcome for any policyholder who fails to account for the IRS's doctrine of inclusion. The step-by-step mechanics of a 2026 IRS audit for divorce insurance often begin with a discrepancy between the 1099 issued by the carrier and the taxpayer's reported gross income. If you do not report the payout, the IRS's automated matching system triggers an immediate notice. But the audit goes deeper. The IRS is now looking at the source of the premiums. If Chloe paid her premiums using a joint bank account, but the payout was issued solely to her, the IRS may investigate whether the premiums themselves were a form of constructive gift to her from her spouse, potentially triggering gift tax implications or further complicating the marital asset division. Historical trends in tax litigation show that the IRS views these products not as casualty insurance, but as a form of specialized investment vehicle. In a landmark 2025 tax court case, the government argued that because the policyholder has a degree of control over the occurrence of a divorce, the risk is not purely fortuitous. Therefore, they argue, the payout should be treated as a short-term capital gain or ordinary income, rather than a tax-free reimbursement of a loss. This reclassification changes the entire ROI calculation for the consumer. If you are paying $500 a month for a decade, you are investing $60,000 of post-tax money. If your payout is $100,000, but you lose $35,000 to taxes, your net gain is only $5,000 over 10 years. In this scenario, the insurance functioned as a very poor savings account with high administrative fees. The tax trap extends into the realm of child support and alimony calculations. In 2026, family court judges are increasingly viewing divorce insurance payouts as gross income for the purposes of calculating support obligations. Imagine if Chloe's ex-husband's legal team discovered her $85,000 payout. In many jurisdictions, that lump sum is added to her annual earnings for that year. This could artificially inflate her income, leading to a higher child support obligation or a reduction in the alimony she might have otherwise received. The very money she bought to protect her future could be used by the court to justify taking more money from her monthly paycheck. We also have to analyze the basis of the contract. In standard insurance, your basis is the amount of premiums you have paid. If you receive a payout that is less than your basis, it might be argued as a non-taxable return of capital. However, most divorce insurance policies are designed to pay out significantly more than the total premiums paid to cover the high costs of litigation. The IRS focuses on the excess amount. For example, if Chloe paid $20,000 in premiums and received $85,000, the IRS treats the $65,000 difference as a taxable windfall. This requires the taxpayer to maintain impeccable records of every premium payment made over potentially 10 or 15 years. Failure to provide this proof during an audit leads to the entire payout being taxed at the maximum rate. The step-by-step reality of the 10-year look-back audit is even more grueling. When a high-value claim is filed, the IRS often uses the opportunity to look for what they call lifestyle discrepancies. If you are receiving a $100,000 insurance payout, the IRS may look back at your previous filings to see if the income you reported in 2022 and 2023 was sufficient to cover your living expenses plus those high insurance premiums. For many self-employed individuals or gig economy workers, this insurance payout becomes the tripwire that leads to a full-scale forensic audit of their entire financial history. Furthermore, we are seeing a trend where insurance companies are now offering tax-protected riders. For an additional fee, the insurer promises to provide a tax gross-up if the payout is found to be taxable. However, these riders are expensive and often contain their own set of exclusions. They may only cover federal taxes, leaving the policyholder responsible for state and local liabilities. In 2026, the complexity of managing the tax implications of a divorce insurance policy has created a sub-industry of specialized CPAs who do nothing but handle marital transition taxation. The potential outcomes for the uninformed are severe. We have seen case studies where individuals were forced to take out high-interest personal loans just to pay the taxes on an insurance settlement they used to pay their divorce lawyers. This creates a cycle of debt that mirrors the very financial ruin the insurance was supposed to prevent. You are essentially paying an insurance company to protect you from a fire, only to have the fire department send you a bill that burns down the rest of your house. This brings us to a critical junction in our documentary. While the financial and tax implications are devastating, there is an even more clandestine layer to this industry. In 2026, a new type of policy has emerged: the third-party beneficiary policy. This is where someone other than the husband or wife, perhaps a concerned parent or a business partner, takes out a policy on a marriage they believe is high risk. This insurable interest in someone else's marriage is creating a legal and ethical firestorm in the United States. In the next part of this deep dive, we are going to expose the world of marriage shorting. We will look at how wealthy families are using divorce insurance as a weapon in estate planning to ensure that a predatory son-in-law or daughter-in-law doesn't walk away with the family fortune. We will reveal the secret contracts that allow parents to profit from their children's failed marriages, and the 2026 Supreme Court case that will decide if you can legally bet on the failure of someone else's "I do." The money is no longer just in the marriage, it's in the exit strategy. The concept of insurable interest has long been the bedrock of the entire global insurance industry. Historically, you could not take out a life insurance policy on a random stranger because you had no financial stake in their survival. Doing so would essentially be a bet on their death. However, in 2026, The legal definition of what constitutes a financial stake is being stretched to its absolute breaking point in American courtrooms. We are entering the era of the third-party marriage hedge, a practice colloquially known among elite wealth managers as marriage shorting. To understand the gravity of this, consider the case study of the Sterling family, a multi-generational real estate dynasty based in Connecticut. In 2024, the patriarch of the family, Arthur Sterling, became concerned when his daughter, Sophia, announced her engagement to an aspiring musician with significant personal debt. Arthur viewed the marriage not just as a romantic union, but as a potential $25 million leak in the family's future estate. Under the laws of many states, even with a prenuptial agreement, certain commingled assets or increases in the value of family businesses can become vulnerable during a lengthy divorce. In early 2025, Arthur utilized a sophisticated financial maneuver. He had the family's irrevocable trust take out a massive third-party divorce insurance policy on Sophia's marriage. This policy was structured so that the trust, not Sophia, was the beneficiary. If the marriage failed after a 7-year period, the trust would receive a payout of $5 million. Arthur's logic was clinical. The payout would act as a hedge to offset the potential legal fees, settlement costs, and the general dilution of the family's wealth that would occur during a high-stakes dissolution. In Arthur's mind, he wasn't betting against his daughter. He was insuring the family's collective balance sheet against a statistically probable casualty. By 2026, this practice has become a standard, albeit secretive, tool for the American ultra-wealthy. The step-by-step mechanics of marriage shorting are intricate. It usually begins with the creation of a specialized limited liability company or a Delaware statutory trust. This entity then applies for the policy, citing an insurable interest based on the potential economic loss the entity would suffer if a key family member or business partner underwent a divorce that forced the liquidation of shares. The insurance carriers, eager for the massive premiums these high-limit policies command, have developed actuarial models that specifically calculate the risk of divorce based on socioeconomic disparity between the spouses. Historical trends indicate that marriages with significant wealth gaps have a 35% higher rate of dissolution within the first decade. The insurers use this data to set premiums that essentially function like a high-yield bond for the family trust. This brings us to the monumental 2026 Supreme Court case, which legal scholars are calling the marital interest decision. The case originated when a former son-in-law in Ohio discovered that his ex-wife's parents had profited to the tune of $2 million from his divorce via a secret insurance policy. He sued, arguing that the policy created a perverse incentive for the parents to actively sabotage the marriage to trigger the payout. The case has moved through the appellate system and now sits before the highest court in the land. The potential outcomes of this ruling will redefine the privacy of the American home. If the court rules in favor of the insurance companies, it effectively legalizes the commodification of the domestic unit by external parties. Critics argue that this creates a toxic environment where the very people who should be supporting a marriage, the extended family, have a multi-million-dollar reason to see it fail. Imagine the psychological pressure on a young couple in 2026 if they know their mortgage-paying parents are essentially shorting their relationship. Case studies from 2025 already show an increase in discovery motions where attorneys are specifically looking for third-party policies. In one instance, a divorce was prolonged by 18 months because the husband discovered his own business partners had insured his marriage, leading him to claim that his partners had conspired with his wife to push him out of the firm and collect the insurance money. The data regarding family-funded policies shows a sharp rise in the Midwest and the Sun Belt, particularly among families owning mid-sized enterprises or large agricultural tracts. For a family farm that has been in the same name for 100 years, a single divorce in the fourth generation can force a sale that ends the legacy. Divorce insurance is being marketed to these families as a way to preserve the land. Instead of a prenuptial agreement, which can be seen as an insult to the incoming spouse, the family quietly pays for a casualty policy. If the marriage ends, the insurance payout provides the cash needed to buy out the departing spouse's interest without selling the North 40. However, the step-by-step reality of filing a third-party claim is a legal minefield. The insurer requires proof that the divorce was not the result of collusion between the beneficiary and the policyholder. In 2026, this involves what is known as a collusion audit. The insurance company's investigators will interview friends, neighbors, and coworkers, looking for any evidence that the parents or business partners played a role in the breakdown of the relationship. They will examine text messages and emails for phrases like "maybe it's time to move on" or "you deserve better," attempting to frame these as attempts to trigger the policy. Furthermore, we must look at the historical trends of how this affects social mobility. Marriage shorting is almost exclusively a tool for those who already possess significant assets. It creates a new form of financial gatekeeping, where the wealthy can protect their hoard from the perceived threat of an outsider. This reinforces the wealth gap by ensuring that marital transitions do not result in the redistribution of capital. The 2026 economy is seeing the rise of the unbreachable estate, where every possible human risk, from sickness to divorce to even the loss of a child's reputation, is fully hedged and insured by a family office. The complexity of these products has also led to the rise of marriage shorting brokers. These are financial advisors who specialize in identifying high-risk marriages within a client's portfolio and recommending the appropriate insurance coverage. They use advanced software to track the health of a marriage, often monitoring the spouse's combined credit scores, the frequency of their travel, and even their joint philanthropic giving. A sudden drop in joint activity triggers an alert to the advisor to increase the policy's limits before a formal separation is announced. As we look at the potential outcomes for the Sterling family and others like them, it becomes clear that the marriage contract is being superseded by the insurance contract. The vows of "for better or for worse" are being translated into a series of premium payments and risk-adjusted returns. The American legal system is struggling to keep up with the speed at which the insurance industry is turning human relationships into tradable assets. We are witnessing the birth of a new kind of financial architecture that treats the home as just another node in a global network of risk management. But there is an even deeper secret buried in the fine print of these 2026 policies. While everyone is focused on the payout of the divorce, the insurance companies have quietly inserted a clause that few have noticed, yet it holds the power to bankrupt a policyholder, even if the marriage remains perfectly stable. In the next part of this deep dive, we are going to reveal the reconciliation clause, a hidden mechanism that allows insurers to claw back premiums or deny coverage for unrelated life events if a couple dares to fix their relationship. The price of saving your marriage might be higher than the price of ending it. The reconciliation clause is the silent killer of financial recovery in the 2026 insurance market, a mechanism designed to protect the insurer's bottom line by penalizing the very act of saving a marriage. To the average person, reconciliation is a triumph of the human spirit, a moment where a couple decides to work through their differences and remain a unit. To an insurance company in 2026, reconciliation is a catastrophic disruption of actuarial data that triggers a series of aggressive financial clawbacks and policy resets. This is not a conspiracy. It is a documented trend in the fine print of contemporary casualty contracts. Consider the case study of Liam, a 42-year-old landscape architect in Denver, Colorado. In 2022, Liam purchased a robust divorce insurance policy as a proactive measure, paying approximately $400 a month into a plan that promised a high-value payout after a 48-month waiting period. By early 2026, Liam had reached the 46-month mark. He had paid nearly $19,000 in total premiums. At this point, the marriage faced a severe crisis, and Liam initiated a preliminary claim after filing for a legal separation, a step allowed under his policy's specific terms to cover early mediation costs. However, during the mandated 60-day cooling-off period, Liam and his wife, Maya, attended an intensive marriage retreat and decided to reconcile. Liam, believing he was doing the responsible thing, contacted his insurance provider to withdraw the claim and move his policy back into a standard active status. He expected a simple confirmation. Instead, he was hit with the step-by-step activation of the reconciliation reset. The first step in this process is the mandatory vesting reset. Under the 2026 Standard Reconciliation Clause, if a policyholder initiates any part of a claim and then withdraws it due to a reconciliation, the insurer has the right to treat the marriage as a new risk. For Liam, this meant that his 46 months of vested time were instantly wiped clean. His 4-year investment did not carry over to the restored marriage. Instead, the clock reset to month 0. If Liam and Maya were to face another crisis in 2027, he would find himself ineligible for a payout because he would once again be within the initial 48-month waiting period. He effectively paid $19,000 for a safety net that was yanked away the moment he chose his wife over the payout. Furthermore, we must examine the potential outcomes of the administrative clawback. Many 2026 policies include a provision that allows the insurer to retain all previous premiums as an earned risk fee if a claim is withdrawn. In Liam's case, the $19,000 was not applied as a credit toward his new reset policy. It was categorized as a fee for the insurer having carried the risk of his divorce for the previous 4 years. In the eyes of the insurance corporation, they provided the service of protection during the marriage's most volatile period, and the fact that the divorce did not happen does not entitle the policyholder to a refund or continued seniority. This historical trend in the mid-2020s shows that the insurance industry has successfully framed marriage as a consumable service rather than an insurable asset. The financial pressure deepens when we look at cross-industry data sharing, a practice that has become ubiquitous by 2026. When Liam withdrew his claim citing reconciliation, the insurer updated his domestic volatility score in a centralized database used by other major carriers. This is often referred to as the domestic instability flag. Within 30 days of trying to save his marriage, Liam received notices from his life insurance and disability insurance providers. Because he was now statistically categorized as being in a high-stress, volatile household, his premiums for unrelated policies spiked by 15%. The logic used by these companies is based on data showing that individuals in failing or fluctuating marriages have higher rates of stress-related health issues and workplace accidents. Liam was essentially being taxed by the entire financial system for having a marital crisis, even though he chose to resolve it. Imagine the psychological trap this creates for a couple in 2026. If you are at month 47 of a 48-month policy and your marriage hits a wall, the financial incentive to simply wait one more month and proceed with the divorce is staggering. The insurance company has essentially placed a bounty on the end of the relationship. If you reconcile, you lose $20,000 in premiums and your clock resets. If you divorce, you receive a $80,000 payout. For a middle-class family struggling with 2026 inflation and housing costs, the reconciliation clause turns a moral and emotional decision into a brutal mathematical calculation. Case studies from 2025 suggest that this specific clause has contributed to what sociologists call the delayed exit phenomenon, where couples stay in a state of high conflict limbo, just long enough to ensure their insurance payouts are secure before finalizing the split. The step-by-step reality of a reconciliation audit is also incredibly invasive. In 2026, insurers use AI-driven social listening tools to verify that a reconciliation is genuine and not a fraudulent attempt to stop a clock or manipulate premium rates. If Liam and Maya stopped posting joint photos or if their geolocation data showed them living in separate residences for more than 72 hours, the insurer could flag the account for a bad faith investigation. In some extreme cases, insurers have even demanded access to marriage counseling records to prove that the couple is actively working on the relationship as a condition of keeping the policy active at all. This turns the insurance adjuster into a third party in the therapist's office, further complicating the very healing process the couple is trying to undergo. We must also analyze the data regarding the success rates of marriages after a policy reset. Historical trends from the early 2020s indicated that once a couple has reached the point of filing an insurance claim, the likelihood of long-term success drops to less than 20%. Insurers know this. The reconciliation reset is not designed to help the couple. It is designed to ensure that when the second, more permanent break happens, the insurer is no longer on the hook for a payout because the couple is back in the waiting period. It is a brilliant, albeit cold, strategy for risk mitigation that exploits the hope of the policyholder. The 2026 legal landscape is just beginning to push back on these clauses. Several class action lawsuits are currently moving through the courts in California and New York, arguing that the reconciliation reset constitutes an unconscionable contract. The plaintiffs argue that an insurance product should not create a financial penalty for a socially desirable outcome, like keeping a family together. However, the potential outcomes of these cases remain uncertain. The insurance lobby argues that without these resets, the entire industry would collapse under the weight of people who churn their policies, filing and withdrawing claims repeatedly to manipulate their financial positions. As we look at the complexity of Liam's situation, it becomes clear that the 21st century marriage is being squeezed by two opposing forces: the emotional desire for stability and the corporate demand for predictability. The reconciliation clause is the point where these two forces collide. For those who think they are buying peace of mind, the reality of 2026 is that you are often buying a set of handcuffs that get tighter the harder you try to fix the problem. But the danger doesn't stop at the domestic level. In the next part of this deep dive, we are going to look at how these insurance policies are being packaged into complex financial instruments on Wall Street. We will explore the world of marital-backed securities and how your divorce might actually be a line item in a billionaire's hedge fund. The same way the 2008 crash was fueled by subprime mortgages, the next financial crisis might be built on the failure of the American heart. We are going to reveal the default swaps of the dating world and how your private struggle is being traded for profit in real time. The financialization of human heartbreak reached its zenith in the early months of 2026 when the first marital-backed security, or MBS, was successfully listed on a secondary private exchange in New York. To the casual observer, the idea of turning thousands of divorce insurance policies into a tradable bond seems like science fiction. But for the titans of Wall Street, it is simply the logical evolution of risk management. Just as the housing market was transformed by the mortgage-backed securities of the early 2000s, the domestic stability of the American middle class is being sliced, diced, and sold to institutional investors as a new asset class. This is the era of the marital tranche, and the implications for the average household are profound. Imagine a quantitative analyst named Jordan working for a global macro hedge fund in 2026. Jordan's job is not to look at stock tickers or commodity prices, but to analyze the aggregated data of 50,000 divorce insurance policies. These policies are pooled together into a single financial vehicle. The steady stream of monthly premiums paid by people like Tyler, Liam, and Chloe, people we have discussed throughout this documentary, serves as the interest payment for the investors who buy these bonds. If the marriages remain stable, the investors receive a consistent yield. If a marriage ends and a claim is paid out, that capital is removed from the pool, reducing the overall value of the security. To manage this risk, Wall Street has adopted the same tranching system used in the subprime mortgage era. The AAA-rated tranches consist of policies for marriages that the AI algorithms deem exceptionally stable. Couples over the age of 45 with high credit scores, shared real estate, and more than 15 years of marital history. These are seen as safe, low-yield bets. At the bottom of the pyramid lies the equity tranche, or what traders call the toxic waste of the marital market. These are policies held by younger couples in high-stress industries with significant income disparity and a history of frequent residential moves. Investors in this tranche take on massive risk for the potential of massive returns, effectively betting on the resilience of these high-pressure unions. Historical trends in the mid-2020s show that this financialization creates a dangerous feedback loop. When a hedge fund owns a significant portion of the marital-backed securities in a specific geographic region, they have a vested interest in the socio-economic factors that influence divorce rates. In 2026, we are seeing the emergence of marital default swaps. These are essentially insurance policies on the insurance policies. A hedge fund can buy a swap that pays out if the divorce rate in a specific demographic, such as tech workers in Seattle or healthcare professionals in Miami, exceeds a certain threshold. This means that while a couple is fighting to stay together, there are rooms full of servers and analysts who are financially incentivized to see them fail. The step-by-step reality of how this data is harvested to fuel these markets is a masterclass in modern surveillance. Institutional investors do not just look at the insurance applications. They purchase anonymized data from marriage counseling apps, retail spending trackers, and even smart home devices. If a high concentration of households in a specific MBS pool starts showing a decrease in shared grocery purchases or an increase in late-night energy usage in separate rooms, the market for those securities begins to price in a higher probability of default. In 2026, the market knows your marriage is in trouble before you have even booked your first session with a mediator. Consider the potential outcomes for the broader American economy. If a localized economic shock hits, such as a major factory closure in the Midwest, it often triggers a spike in marital stress. In the old economy, this was a social tragedy. In the 2026 economy, it is a financial catastrophe for the holders of marital-backed securities. A wave of simultaneous divorces across a specific region can trigger a mass liquidation event. Because these securities are often used as collateral for other complex financial trades, a sudden spike in the divorce rate in a single state could, theoretically, lead to a liquidity crisis in the global banking system. We are essentially backing our financial infrastructure with the most volatile substance on Earth: human emotion. Case studies from the 2025 pilot programs for these securities reveal a disturbing trend known as the algorithmic squeeze. When insurance companies know their policies are being sold to Wall Street, they face immense pressure from the bondholders to deny claims. The reconciliation clauses and the material misrepresentation traps we discussed earlier are not just bureaucratic hurdles. They are the defense mechanisms of the security. Every denied claim is $1 of profit for the bondholder. This creates a systemic bias against the policyholder. If you are a single person fighting an insurance company, you are no longer just fighting an adjuster. You are fighting the collective financial might of a pension fund or a sovereign wealth fund that needs your claim to be denied to meet its quarterly earnings targets. Furthermore, we must analyze the role of the big data brokers in this 2026 ecosystem. Companies that specialize in domestic analytics provide what they call a marital stability index to the ratings agencies. This index is updated in real time. Imagine if your ability to get a car loan or a business expansion credit was influenced by the current trading price of the marital-backed security your household is bundled into. We are seeing early signs of this integration. A high-risk marital score can lead to higher interest rates across the board, as banks perceive the potential for a divorce-related liquidation as a threat to your overall creditworthiness. The transition from a private domestic contract to a public financial asset has also given rise to the professional marriage short seller. These are individuals and firms who actively look for structural weaknesses in the institution of marriage within certain sectors. For example, if a new law is passed in a specific state that makes it easier to liquidate retirement accounts during a divorce, short sellers will immediately move against the MBS pools associated with that state. They are betting that the legal change will act as a catalyst for a wave of filings. This is the dark side of 21st century finance. The profit motive is now directly tied to the dissolution of the nuclear family. The step-by-step process of securitizing these policies also involves a layer of complexity known as the automated servicer. In 2026, many of these insurance pools are managed by AI systems that handle everything from premium collection to initial claim review. These systems are programmed to maximize the internal rate of return for the investors. If the AI detects a pattern that suggests a couple is trying to game the system, perhaps by filing for divorce just as their vesting period ends, it can automatically trigger an audit or a premium hike across the entire pool to offset the projected loss. This means that the actions of a few can financially penalize thousands of other couples who are in the same security. As we look at the potential outcomes of this systemic financialization, we have to ask, what happens when the bubble bursts? Historical trends in American finance show that every asset class that undergoes rapid securitization eventually faces a reckoning. In 2026, the marital-backed security market is currently valued at over $400 billion. It is a tower built on the hope that Americans will continue to pay their premiums and that their divorces will happen at a predictable, manageable rate. But human behavior is rarely predictable, and the stresses of the 2020s are unlike anything the actuarial tables have seen before. The reality of the 21st century is that your marriage is no longer just yours. It is a data point on a spreadsheet in Lower Manhattan. It is a hedge for a billionaire in Singapore. It is a casualty of a default swap in London. The walls of the home have been made transparent by the light of the computer screen, and the financial sharks are circling. But while Wall Street is busy trading your heartbreak for profit, a new and even more radical shift is happening on the ground level. In the next part of this deep dive, we are going to explore the emergence of the Decentralized Marital Autonomous Organization, or the Marital DAO. We will look at how couples in 2026 are bypassing traditional insurance companies and Wall Street altogether to form private, blockchain-based risk-sharing pools with their friends and neighbors. We will reveal the secret world of peer-to-peer divorce protection and why the government is terrified of a marriage that can't be tracked, taxed, or traded. The revolution will not be televised. It will be encrypted. In the digital shadows of 2026, a new form of resistance has emerged against the traditional insurance giants and the prying eyes of the IRS. It is called the Marital Decentralized Autonomous Organization, or the Marital DAO. This is not just a financial tool. It is a total reimagining of the domestic contract, built on the principles of anonymity, peer-to-peer trust, and immutable code. To understand why this is the fastest-growing sector of the underground economy, imagine a couple named Ben and Elena living in a tech-integrated community in Austin, Texas. Ben and Elena are part of a generation that saw the 2025 regulatory crackdown on traditional divorce insurance. They watched as the government began taxing payouts, and as insurers used AI to spy on marital health. In response, they joined the Unity Protocol, a private, blockchain-based marital DAO. The step-by-step mechanics of a marital DAO are drastically different from a corporate policy. Instead of paying premiums to a centralized company, Ben and Elena contribute a monthly amount of stablecoins, digital currency pegged to the US dollar, into a smart contract. This contract is not controlled by a person or a board of directors. It is a self-executing piece of software living on a decentralized ledger. Their funds are pooled with those of 500 other couples within the same protocol. These funds are then automatically deployed into decentralized finance lending markets, where they earn a yield that remains within the pool, compounding the total value of the collective safety net. This is what historical trends in the crypto economy call a self-funding risk pool. The most radical aspect of the marital DAO is the removal of the insurance adjuster. In a traditional system, a corporate employee decides if your divorce is valid for a payout. In the Unity protocol, this decision is handled by a decentralized oracle and community governance. When a marriage within the DAO reaches its breaking point, the process for a claim is clinical and transparent. The protocol utilizes what is known as a zero-knowledge proof to verify the filing of a divorce decree through an encrypted link to public court records. Once the oracle, a software bridge between the physical world and the blockchain, confirms that the legal status of the marriage has changed, the smart contract automatically triggers a payout to the individual's private wallet. There are no forms to fill out, no phone calls with adjusters, and most importantly, no paper trail for the IRS to easily follow. However, the potential outcomes of this system are not without significant risk. In 2026, we are seeing the rise of the social slashing event. Within a DAO, the community often has the power to vote on whether a claim is legitimate, or if a couple is attempting to exploit the system. If Ben and Elena were to attempt a paper divorce, dissolving the legal marriage while continuing to live as a couple just to collect the payout, the other members of the DAO could initiate a challenge. If the community votes that fraud is occurring, Ben and Elena's entire stake in the pool could be slashed, meaning their years of contributions are distributed among the other members as a penalty. This turns the insurance pool into a form of hyperlocal digital surveillance, where your neighbors have a financial incentive to ensure you are being honest. The 2026 regulatory landscape has reacted to these DAOs with unprecedented aggression. The Securities and Exchange Commission and various state insurance commissioners have launched what is being called Operation Marital Sweep. They argue that these DAOs are effectively running unlicensed insurance businesses and selling unregistered securities. For the government, the marital DAO is a nightmare because it creates a post-state marriage. If the premiums are paid in crypto and the payouts are handled by code, the government loses its ability to tax the transition, track the flow of assets, and enforce traditional alimony and child support structures. Historical trends in state power suggest that the government will eventually move to ban the interfaces that allow people to interact with these protocols, creating a digital cat-and-mouse game between domestic privacy and federal oversight. Case studies from early 2026 have already highlighted the catastrophic potential for smart contract vulnerabilities. Imagine a DAO called the Forever Fund that had over $200 million in marital assets locked in its vault. A malicious actor identified a flaw in the governance code, a logical error that allowed someone to create thousands of fake marital profiles and vote themselves a massive claim. In what is now known as the flash divorce attack, the entire pool was drained in less than 60 seconds. Because the system was decentralized, there was no customer service line to call, and no regulatory body to step in and restore the funds. The couples in that DAO, who thought they were buying the ultimate protection, were left with nothing. This is the brutal reality of the 21st century frontier. When you remove the middleman, you also remove the safety rails. Furthermore, we must analyze the data regarding the psychological impact of the DAO. In a traditional marriage, the couple is accountable to each other and perhaps their immediate community. In a marital DAO, they are accountable to a global network of anonymous stakeholders. We are seeing a historical trend where the pressure to perform a healthy marriage becomes an economic necessity. If your social media sentiment or your public interactions suggest a failing marriage, the DAO's risk assessment algorithms might automatically increase your required monthly contribution to the pool. In 2026, your reputation is literally your premium. The tax implications of the DAO are also reaching a boiling point. The IRS has recently proposed a new rule that would classify any interaction with a marital DAO as a reportable event under the Digital Asset Anti-Tax Evasion Act. Even if you don't receive a payout, the government wants to know how much you are contributing, as they view the yield earned within the pool as taxable income. This has led to a split in the American public. those who are willing to pay for the transparency and legality of traditional insurance, and those like Ben and Elena who are willing to risk federal prosecution for the sake of total financial autonomy. The step-by-step reality of living in a DAO-protected marriage is a constant exercise in digital hygiene. Ben and Elena must ensure their private keys are secure, their digital identities are verified, and their participation in the governance votes is consistent. If they miss a vote or fail to update their status, they could lose their seniority in the pool, similar to the vesting resets we saw in traditional policies. The labor of maintaining the insurance has become as demanding as the labor of maintaining the marriage itself. As we move toward the final conclusion of this deep dive, we have to recognize that the marital DAO represents the ultimate commodification of the human heart. We have moved from marriage as a sacrament to marriage as a contract to marriage as a casualty policy, and finally to marriage as an encrypted asset class. The transition is complete. The American home is now a node on a network, and every argument, every reconciliation, and every final goodbye is being priced in real time by a machine that never sleeps. The question that remains is not whether you should insure your marriage, but what you lose when you do. Is it possible to have a truly intimate connection when you have already pre-funded your exit in an anonymous digital vault? The data is inconclusive, but the societal shift is undeniable. We are a nation that has traded the risk of heartbreak for the security of a smart contract. In the final part of this documentary, we are going to look at the ultimate destination of this trend. We will reveal the 2027 project that aims to create the first synthetic spouse, a legal and financial entity that allows you to enjoy the tax and social benefits of marriage without ever actually having a partner. We will look at the final gavel on the concept of the nuclear family and what the 21st century version of happily ever after actually looks like when the lawyers, the insurers, and the algorithms are finished with it. The end of marriage as we know it is just one click away. This final stage of the evolution is the culmination of everything we have discussed. In 2027, the first pilot programs for the marital proxy entity are scheduled to launch in states like Nevada and Delaware. To understand the magnitude of this shift, we must look at the character of James, a 45-year-old executive in Seattle who has already been through 2 traditional divorces. James has lost nearly $4 million in legal fees and asset division over the last 15 years. For him, the concept of divorce insurance was a step in the right direction, but it still required the presence of another unpredictable human variable. James represents the vanguard of a movement that seeks to decouple the legal benefits of marriage from the biological and emotional risks of a partner. The Synthetic Spouse Project is essentially the creation of a single-member domestic LLC that the state recognizes as a marital partner for tax and insurance purposes. Under the proposed Domestic Innovation Act of 2027, an individual can register their own estate as a separate legal person and then enter into a fiduciary marriage contract with that entity. This allows James to claim the married filing jointly tax status, access family rate insurance premiums, and secure Social Security survivor benefits for his heirs, all while remaining legally single in the eyes of the dating world. This is the ultimate hedge against divorce because you cannot divorce yourself. For the insurance industry, this is the final product, the proxy policy. It protects the individual from the financial liabilities of loneliness while removing the casualty risk of a spouse. To see how this works step by step, we must look at the legal filing process for James in 2027. First, James transfers his primary residence and his investment portfolio into the James Marital Trust. Next, he applies for a synthetic spouse certification from the state, which requires a significant administrative fee and a mental health evaluation to ensure he understands the fiduciary nature of the contract. Once certified, James can apply for proxy insurance. This policy is significantly cheaper than the divorce insurance we have studied because the risk of dissolution is near zero. However, the potential outcomes for the broader economy are staggering. If a significant portion of the high-earning American public moves towards synthetic marriage, the tax revenue generated from the divorce industrial complex, the lawyers, the mediators, and the court fees will vanish. The government is currently debating a lifestyle tax to offset this loss, creating a new financial burden for those who choose to live outside the traditional domestic risk pool. Historical trends show that whenever we attempt to automate away a human struggle, we create a secondary layer of complexity. We have spent the last 9 parts of this documentary looking at how divorce insurance transformed from a niche product into a global financial instrument. We saw how it influenced the way people argued, the way they reconciled, and the way they were traded on Wall Street. But the data from 2026 suggests that divorce insurance was merely the cocoon phase for this new synthetic reality. The potential outcomes of a society where marriage is a solo financial strategy, rather than a partnership, are already appearing in the census data. In 2026, for the first time in American history, more than 50% of households are occupied by a single individual. The isolation is complete, and the insurance industry has optimized it for maximum profitability. Consider a case study involving a younger professional, Sarah, who is entering the workforce in 2026. Sarah has no interest in traditional marriage because she has seen the wreckage of her parents' divorce. She views a partner as a high-risk liability. Instead of seeking a husband, she seeks a domestic co-investor. They do not live together, they do not have children, and they do not share a bedroom. They simply share a marital proxy entity to lower their cost of living and maximize their tax returns. They each hold a divorce insurance policy on the other, but it is structured as a business interruption policy. If one of them decides to leave the agreement, the insurance pays out to cover the administrative costs of dissolving the entity. In this scenario, the heart has been completely removed from the equation. The insurance policy is the only thing keeping them together, as the cost of breaking the contract prematurely is higher than the benefit of leaving. This leads us to the final gavel on the concept of the nuclear family. In 2027, the Supreme Court is expected to hear a case regarding the parental rights of synthetic spouses. If James has a child through surrogacy, does his marital proxy entity have legal standing as the second parent? If so, the insurance industry will begin offering parental proxy policies, which ensure the child's future against the death or bankruptcy of the primary parent. We are building a world where every human connection is replaced by a financial guarantee, and every emotional bond is reinforced by a premium payment. The historical trends of the 21st century indicate that we are increasingly willing to trade our vulnerability for a sense of mathematical certainty. But there is a cost that the actuarial tables cannot calculate. When we insure ourselves against the failure of our relationships, we also insure ourselves against their growth. The struggle of a marriage, the messy, difficult, and often expensive process of two people becoming one, is the very thing that builds resilience in a society. By commodifying the exit strategy, we have made the entrance less meaningful. The data on human happiness in 2026 shows a paradox. We have more financial security in our domestic lives than ever before, yet we report the highest levels of loneliness and lack of purpose in recorded history. The insurance policy has provided the floor, but it has also lowered the ceiling. The transition from I do to I am covered is nearly complete. As we look at the final data points of this documentary, we see that the American dream has been rebranded. It is no longer a house with a white picket fence and a lifelong partner. It is a diversified portfolio with a high-limit divorce insurance policy and a marital proxy entity that ensures you never have to lose 50% of what you own. We have successfully managed the risk, but in doing so, we may have eliminated the reward. As you step away from this masterclass, you must ask yourself, if you could insure your heart against every possible break, would you still have the capacity to feel? The insurance companies will tell you that the potential outcomes are all positive: stability, security, and peace of mind. But the historical trends of our species tell a different story. We are defined by our risks, not our hedges. The next chapter of the American story will not be written in a courtroom or an insurance office. It will be written in the spaces between us that haven't yet been quantified, taxed, or insured. But the story of the 21st century doesn't end with marriage. The same forces of financialization and risk pooling are now moving into the most intimate parts of our physical existence. In our next documentary series, we are going to dive into the world of biological liability insurance. We will reveal the 2027 tech that allows you to insure your own DNA against genetic drift, and how the insurance companies are now claiming ownership of your offspring's future earnings as part of your premium. The battle for your heart is over. The battle for your code has just begun. What happens when the insurance adjuster is no longer in your wallet, but in your blood?